My name's Colin Howe. I'm a partner in Hillier Hopkins, resident in the Milton Keynes office. What we're going to be doing, we're going to be covering the new pensions legislation coming in on the 6th of April, but a little bit wider than that. We're also going to be going back over some of the existing rules and how that impacts on both family company planning and personal planning, both for income tax and for inheritance tax purposes, and some slightly wider thoughts and processes as well. We're going to try and debunk some of the newspaper headlines that you may have seen over the 3 or 4 months leading up to this change. Rubbish has been talked about, these penal tax charges that you might incur if you take money out of your pension. They're only penal if you don't do it right. So if you plan for it, the tax charges are quite manageable and indeed are much more flexible than the existing arrangements. The next line says health warning, and in fact I don't think this applies now because I wrote this slide last week. At the time that I wrote this slide, there was still something like 17 or 18 statutory instruments that were still to be brought into legislation. So what we were talking about was actually still draft, but I think I'm right in saying that over the course of this week these are being brought in. So what we're talking about now is pretty much live legislation. We're going to be talking about, as I said, about planning opportunities, not just about the sort of technical side of this. And there are a couple of pointers for things that some of you might want to do before the 6th of April 2015. So starting with just a broader overview of what a pension encompasses, it is a very specific type of investment designed to help you save for retirement. You start off by making contributions into a pension scheme. Those contributions qualify for tax relief that they always have done, and they still do. There is some talk about how much tax relief you might get on that under a new government, which David will come on to later. But essentially, you've got to fund your pension. I'm going to be talking in a little bit more detail about the rules for that. That contribution goes into a pension fund. That fund can take many guises. It could be a company pension fund. It could be a personal plan, and that either of those could be with an insurance company, an insured arrangement, or a self-insured arrangement where you control your own investments. But the whole principle is that those investments grow in a tax-free environment. So tax incentives on the way in, tax incentives while the pension is growing. We're not going to talk very much about the funds itself, but we then go on to cover, and these are the two areas which the new rules in 6th of April really do affect. This is how you get your money out of the pension and the timing of that. So you contribute, it grows, you retire, in inverted commas, because you don't have to retire. That's an outdated concept. You get your tax-free cash, 25%, always has been, still going forward, but a little bit more flexibility on that again. And then you draw income from it. And that income now can be done in a variety of different ways, which you can use to suit your own personal circumstances. And then you die. And historically, dying has not been good news for pension schemes. But the new rules, again, make it, sounds a bit strange, much more attractive to die. Okay? But do it before you're 75. And again, I'm preempting David. So that death, there's a big difference if you die before 75 and after 75. So I use the word retire, I hate people that do that, in inverted commas. So in the good old days, when you hit 65 as a man or 60 as a lady, you retired, you got your state pension, it was a one-off event, you took your 25% lump sum and you bought an annuity. This is no more, ladies and gentlemen. What you have now, rather than a happy retirement party, you have a happy benefit crystallisation event. Catchy, isn't it? And you don't just have one of those, or potentially you don't just have one of those, you have quite a lot of those, and you can crystallise benefits multiple times after the age of 55. And David will be talking much more about that. That's just to give you a preface. And what that means is you're much more flexible in the way you can get your money out of the pension funds. Now, during the course of the evening, we will be using a lot of acronyms. You've had advance warning of this one. BCE. It was on the previous slide.
Benefit crystallisation.
Well done, Lynn. Okay. Benefit crystallisation effect. The rest will become apparent as we go on. We're going to talk about planning opportunities, and there are opportunities for different age groups, whether you're under 55, 55 to 75 and 75 plus, and indeed in the age ranges 55 to 75, whether you're still working or have actually given up work. I'm not going to use the word retirement because it really doesn't apply anymore. All of these changes will affect how and what you invest in, whether you prioritise tax-efficient savings like ISAs, or now called NISAs, or pension, and the thinking on that has probably changed a little bit. The income tax reliefs you qualify for, and wider tax planning like your family company distribution policy will be affected by these changes. Interaction with CGT if you're selling your company, how you can use those proceeds, and also it's now a very, very effective inheritance tax planning tool because of the changes to the death rules. So I'm now going to talk very briefly about the contribution rules. These contribution rules are unchanged. They're not part of the new legislation, but it's important, I think, that you understand what you can and can't do on contributions. So contributions you make can be from yourself personally or from a company. They can go into a company scheme or they can go into a personal plan of some sort. So the permutations are endless. And if we look firstly at personal contributions, what the rules are and what the limits are and what you can do. Subject to an annual allowance, okay? This I will explain on the next slide, so bear with me. Subject to a lifetime allowance, okay? So there's a maximum sum you can build into your pension pot without incurring penalty charges. Again, I'll explain that a little bit more. The key thing with personal contributions is that it's limited by reference to your income, your personal income. And income for this purpose doesn't include dividends. It's only what's called net relevant earnings, pensionable income. So it includes your salary, essentially. Now, if you're in a typical family company where you're using a distribution policy which perhaps minimises the salary and maximises dividends because of the national insurance saving and the income tax saving, then that really limits the amount potentially that you can put into a pension scheme as a personal contribution. There is a de minimis. You can stick in 3,600 individually without having any salary. So that's a small amount you can put in personally. And you get tax relief at your marginal rate of income tax. Now, when you put money into a pension scheme personally, you pay it net of basic rate tax. Okay? So if you stick £8,000 in, the government adds £2,000 to that, to your pension pot. So you've got a gross contribution of £10,000. The £10,000 you then put on your personal tax return and you claim the higher rate tax relief through your personal tax assessment. So who would like to tell me what the marginal rates of tax are? What are the higher rates of tax? It's a trick question, so don't fall for it. Okay, you've got a higher rate of tax of 40%, which kicks in when you've got income of about £41,385.20p. And you've got a 45% rate, which kicks in at about 150,000. Okay, the problem is, and that's advertised as the top rate of income tax, the problem is that's not true in reality. Because if your income reaches a level of 100,000, between the level of 100 to 120, you start to lose your personal allowances. So income between 100 and 120, there's an effective tax rate of 60%. So if you're planning and you think you're in that level, then it's well worth making pension contributions to take you down below the 100,000 level. The other kicker where there's effectively a higher marginal rate of tax is if you're in receipt of child benefit, and that child benefit starts to be abated once you hit the income of £50,000. And again, you can use pension contributions to bring yourself down below that level. So those are pretty good uses of personal pension contributions. What is less well known are the contributions that an employer can make. And the employer, again, doesn't have to be a company pension scheme. The company can make contributions into your personal pension plan, subject to the annual allowance, as the personal contributions are, and subject to the lifetime allowance. So those are both overriding caps for both types of contribution. But there is no limit to the amount of contribution the company can make, and it is not tied to your personal income levels. The caveat is that to qualify for corporation tax relief, you must be able to justify to the Inland Revenue that it's for the benefit of the trade. I personally have never known the Inland Revenue to take that argument and make the argument, and in any event, their own manuals say that you base that argument based on the whole package, including the pension, rather than just the salary. And again, for a lot of small company owners who are taking a small salary, maybe £7,800 or £10,000, the pension contribution at a higher level is justified as part of the entire and the whole package. So you can get much larger sums into your pension pot through a company contribution. You qualify at 20%, you get corporation tax relief on that. And if you're doing this for employees, for example, there's a benefit to both of you because you get a national insurance saving if you do it as a salary sacrifice. So sacrifice the salary and pay contributions directly into their pension pot. So I promised we'd look at contribution limits. This is the annual allowance and the lifetime allowance. The lifetime allowance is misunderstood quite widely and it can get quite complicated. But essentially, you are not allowed to build up a pension pot of more than £1.25 million. Sounds a lot, but it doesn't actually buy a lot of pension if you were going to buy an annuity with it. So this is not contribution based, it's what your pot builds to as the investments grow if you've had hopefully a successful investment strategy. So that's the lifetime allowance. There is also an annual allowance. This is contribution based and is the maximum you can put in any 1 year into your pension. So from 6th of April 2014, i.e. for the current tax year, that is £40,000 per annum, and you can use 3 years unused relief from the previous 3 tax years. And I've got an example where I'll come on to do that. But it's just interesting to note that in an environment where the government is trying to encourage you to make your own personal pension provision, that over the 4 years since 2010-11, that lifetime allowance has reduced from 1.8 million to 1.25 in stages, and the annual allowance of what you can put in has reduced from 255,000 to 40, which doesn't seem to quite gel with the overriding strategy. So if we look at, there's an acronym there I didn't mention before, FIFO. If we look at the annual allowance examples, what this means is, by example, for these 3 tax years, the annual allowance was actually 50,000. It was only brought down to 40 last April. So if you made a contribution in that tax year of 25, you've got unused of 25, 30 there, unused of 20, 35, unused of 15. So over the 3 previous tax years, you've got an unused capacity of 60,000. Now you might think, well, I shall stick 60,000 in straight away just to use that unused capacity, and then I've got this year's still to use. Unfortunately, it doesn't work quite like that. FIFO means first in, first out, and what happens is that you pay your 60,000 in 2014-15. It uses the current year's allowance first, the 40,000, and then the balance, the 20,000, gets taken back first in, first out to 2011-12. So if you only pay 60,000 at that point, and you get past the 6th of April, you've lost £5,000 of your capacity. So important to work that out and to make sure that, again, if you don't use it, you lose it. So if you're keen to make contributions, get that sum right before the 5th of April. The 40,000 contribution limit can be restricted once you enter drawdown. So if you start drawing against your pension, the limit is reduced from 40,000 to £10,000 per annum. So this is when you have one of these crystallisation events I was talking about. And this is an anti-avoidance measure because what they're trying to stop people doing is if you, let's say you're in a company and paying yourself 60,000 as a salary, instead of paying 60,000 salary, you'd stick it in 60,000 into your pension scheme, you'd take 25% of that tax-free. Let's do 40,000, numbers are easier. 25% of that tax-free is 10,000, and then you take 30,000, and as David will point out, that will be done at 25%, at 20%, sorry, the marginal tax rate. And then what you would do next year is you do exactly the same thing. So instead of paying income tax and national insurance on 60, you put it in a pension scheme and draw it out as income from the pension scheme. The government are wise to that. That's what this MPAA, the money purchase annual allowances. Once you've done that and started drawing the income, you cannot then put another 40,000 in. The allowance is reduced to 10,000 per annum. There is one exception to this, which again is a time-limited opportunity, is if you are currently over 55 and you enter into what's called a capped drawdown arrangement to take pension income before 5th of April 15, so potentially you want to carry on working but you want to draw a small amount of pension going forward, you can do that before the 5th of April 15 and not limit your future contributions to the 10,000. After 5th of April 15, capped drawdown ceases to exist, so you can't do it after that date.